Good afternoon, everyone. Thanks for joining us again for our Wednesday workshop. Today, we have a great topic, say goodbye to 1031 exchanges and hello to self-directed IRAs with our guest, Lane Kawaoka. He's one of good friends of mine that does syndications. He's out in Hawaii. Before we get started, just a few things I want to mention. Here at NuView Trust, we are a self-directed IRA custodian. We do not give any tax, legal, or investment advice. It's really up to you as the client to figure out where you want to put your money, and then you direct us where we send the money for that investment. So it's up to you to do your own due diligence, of course. It's very important. And we have lots of content on how to do due diligence, lots of checklists that you can find on our website if you're unfamiliar with doing due diligence before you make any investment. So what is a self-directed IRA? Self-directed is exactly what it sounds like. You direct your investments. You go out there, you find that investment. As long as it's within the IRS guidelines, we can hold it. Only things we don't hold are publicly traded assets like stocks, bonds, and mutual funds. And self-directed IRA, it is a marketing term. Some companies will call their accounts self-directed, but you're still limited to the stock market. But here at NuView, it's a true self-directed IRA where you can diversify your retirement portfolio into alternative assets like real estate, do private lending, you can do notes, you can invest in private entities. So the list goes on, and I'll mention a couple more in a few seconds. So the benefits of having a self-directed IRA for those newbies out there, it's the tax savings. You can make an investment using a tax vehicle like a Roth IRA or a solo 401k or a health savings account, and those will grow for you tax-free if you do it the right way. Or you can do a tax deferred account like a traditional IRA or a SEP IRA. And not only that, a lot of people that are listening are already making these type of investments. They're just doing it in their own cash. And many times they just didn't know that they can do it in a retirement vehicle. So that's why we do these workshops. We want to make sure we bring awareness to the self-directed IRA world and teach people that there are plenty of other options. And would you rather do it with your own cash and be taxed, or do it in a retirement vehicle? So these are the plans that are most common. You have your personal plans like a Roth IRA and a traditional IRA. They're just taxed differently. The way it works is, would you rather pay your taxes on the seed or the crop? So Roth IRA, you pay the taxes on your contributions and it grows tax-free. Traditional IRA, you will not pay the taxes on your contributions. It's actually tax deductible and it grows tax deferred. So that means you don't pay the taxes until you start taking your distributions after the age of 59 and a half. Employer plans, you have your solo 401k, SEP IRA, and simple IRA. So a solo 401k, one of my favorite type of plans. If you're self-employed with no employees, this is a plan you definitely want to look at. You can always reach out to NuView and we can share some content on how the solo 401k plan works. The SEP IRA is great for anyone with a small business. You can definitely exceed the contribution limits compared to a Roth or a traditional IRA, because you can contribute up to, last year was $58,000, which is a lot of money. And then they actually increased it this year to $61,000 for 2022. So you can put a lot of money away if you don't already have a retirement account. But you do have to be self-employed for that plan, as well as a solo 401k. And then the simple IRA is great for small businesses, maybe less than 10 employees. That's a plan you might want to look at as well. And then you have your special plans. Most people don't know you can self-direct these. The health savings account is pretty cool because it's tax deductible going in. So your contributions are tax deductible, and then it grows tax-free. So when you take the money out for any medical expenses, you're not paying taxes on that. That's a great plan to have. If you have a high deductible health care plan, you might want to look into having a health savings account if you don't already have one set up. And then you have your Coverdell education savings account. So this one's not tax deferred, or it's going to grow tax-free, but only for education expenses, but you can't write it off on your taxes when you make the contribution. So it's not tax deductible. Something to definitely look at for your kids or grandkids, nieces, nephews. $2,000 is the max you can contribute. But the cool thing about these plans is, if you are eligible for multiple plans, you can partner them together on investments. And that's the true way of diversifying your portfolio and building your wealth. So these are the types of investments that most commonly we see our clients do, but there's plenty others out there that are pretty interesting. Real estate, so foreclosures, tax liens, multifamily apartments. I like syndications myself. Your option contracts, condos, so Airbnbs, things like that, unimproved land, commercial property, and offshore real estate. Then you have your promissory notes, probably the next most common type of investment we see our clients making. You have secured or unsecured notes. So secured means you might be secured by a piece of real estate, but there's other things you can secure a note with. The most common is real estate. So just like you go to a bank and you take a mortgage out, well, you're the IRA owner and you could lend to whoever the borrower is, and it could be secured by the real estate. So just like a bank, if you don't pay the bank back for that property, the bank can foreclose on the property. Same thing with your IRA. You own the title and the deed to that property until that loan is paid off. If the borrower doesn't pay you back, you can potentially foreclose on that property as well. And then there's unsecured notes. Typically they have higher interest rates, but it is not a secured note. So if the borrower doesn't pay you back, you're taking a little bit of a chance there, more risk with more reward. So it's something you want to definitely strategize and see what works best for you. Private entities, you can definitely invest in things like limited partnerships, joint ventures, LLCs, trusts, Reg Ds, any crowdfunding, anything like that would fall under the private entities. And then your cryptocurrency, we're seeing a lot more of that these days. So Bitcoin, Ethereum, Litecoin, and there's a couple of different ways you can invest in crypto. You can either do it through ErisX that we have right now, or you can create an LLC that gives you what's called checkbook control, and then move it into a bank account where then you can control your own money and diversify your portfolio within that checkbook control LLC. All right. So with that being said, I'm real happy for our guest, Lane. He's going to go ahead and take over from here. He has some great pointers for you and some great advice on investing and how you can do it in real estate. Hey, Lane, how's it going?
Thanks for having me, Brian.
Good
Hello,
to have you again.
everybody. So, we'll try and keep this interactive. I'm pretty good at watching the Q&A box while I'm giving my own presentation. But if anybody has any questions moving along, feel free to type it in and we'll try and get to it. And if you want to stop me, Brian, feel free to do so. But we're going to be talking about saying goodbye to 1031 exchanges and a little bit of self-directed investing, how my clients will use them. But first, I'm going to kind of go over a little bit of my history and how I got up to this point, how I quit my job. It's been maybe about several years. 2018, I think, is when I finally quit my engineering job. But today, I'm the owner and lead syndicator of the Huido Pipeline Club at simplepassivecashflow.com. We've acquired over $1 billion of real estate thus far and brought in $140 million of equity within our group to fund a little over 7,800 apartment units and over 50 projects. And why are we doing this? Well, a couple of things. Well, first, if you were born in the early 80s, or you're a video gamer, you kind of understand this. There's the old Sonic the Hedgehog before they started to make all those movies with Jim Carrey. You're running along, and then you got all your money in your 401k, all these programs that you're supposed to put your money into, and then you lose it, and then it kind of goes right back up. But this volatility is just driving you crazy, and we're all kind of growing up to kind of follow all this financial dogma, which is invest in your 401k, where you just invest in these kind of garbage investments that are retail investments where most of your returns are getting taken away from you. Kind of one of the solutions there is to put into a self-directed IRA or some kind of solo 401k and get it out of that cafeteria of options like the mutual funds, with the Fidelities, the Vanguards. I don't know if I could say those names, Brian. Correct me if I can, or you can edit those out. But those are the big Wall Street companies that kind of want your money because they make heavy fees on it. And then, of course, buy a house to live in, which I'm not a huge fan of, especially for younger people under $1 million net worth, and pay down your debt, right? The debt's the best part of this. My professional resume, have a couple of civil engineering degrees. 2007, I graduated from college, started working as a construction supervisor for the railroad. And then I switched over to more of an office job as a project engineer shortly thereafter. All during this time, just being that W-2 semi-high paid engineer, 2015, I switched over to a city engineer in Kirkland, Washington. And then 2017, I moved back home to Hawaii to be an airfield engineer to work on some airport projects. But, who likes to work for anybody else? I think that's what everybody's shooting for, is the freedom. And so 2019, I called it quits, and I just started to kind of work on my own deals. And just a little bit more about me. What powered a lot of this, and I'm going into like how I did this on the real estate side, which is actually a lot more exciting than the boring professional world that I lived in. But a lot of this is powered by being very frugal with my money, which if you follow anybody who's kind of grown their net worth, it was started with maybe several years to a decade plus of frugality and being good with your money. And here's just some fun ways that I used to save my money back in the day. Today, definitely a little bit different. I would say several years ago, I definitely changed my mentality of, I'm going to have my Starbucks latte. I'm going to buy things that make me happy and trade money for time. When before, it was definitely trading time for money. Like I said, I grew up in Hawaii. 2003, I moved to Seattle to go to college at the University of Washington to follow this linear path of becoming an engineer, because that's what I thought I was supposed to do. Graduated in 2007, but 2009, I began investing in a house in Seattle, because again, that's what you're supposed to do, right? You're supposed to buy a house. But because I was traveling all over for work, I decided to rent it out. And this is where I realized, wow, this cash flow thing is real. And if I just rinse, wash, repeat, do this again and again and again, I'll be able to build up passive income streams to be able to quit my job. So for a young 20-something-year-old kid, the rents were $2,200 and my PITI was $1,600. I knew nothing about the old 50% rule and putting money away to CapEx. I just knew that there was $600 a month of beer money back then, and this kind of just started the snowball effect in 2012. From 2009, I bought that first rental property. So 9, 10, 11, 12, I'm just saving my money, saving $50,000 to $100,000 every single year. And at that point, I went out of state for cash flow, because a lot of investors, they get on the cash flow train and they stop investing in places like Seattle, where I was, California, New York, places, or Hawaii. And I was just sucking in all this information at that time. There weren't too many podcasts, but just reading books and just talking to a lot of investors. By 2015, I had 11 single-family homes in Birmingham, Atlanta, Indianapolis, and one in Pennsylvania. At that point, I really started to invest my money get into paid mastermind groups, education groups. And that was when things really started to move for me. 2009 to 2015, just kind of did all myself. But again, 2015 is when I started to get out of my shell, talking to other high net worth accredited investors, and realize what they were doing. And that was kind of when I started to move from these little single family homes into apartment complexes. And from a numerical standpoint, this is how it all kind of started, roughly. This is called a Sankey diagram. If you guys have trouble communicating with your spouse where your money is all going and what's it all for, I would recommend going online, and you can create one of these things for yourself. Just Google Sankey diagram. But the way this diagram works is, on the left side, these are your income, and then on the right side is how your expenses are broken out. And this is me, when I was in my early 20s. I worked in construction as a supervisor. And this is how it went along. Bought a rental down there on the bottom right, and then it created some savings. And then the next year, I bought another rental, created even more savings. And then, just as you can imagine, this kept going on and on and on. And after a while, these savings gets to be about like maybe half of your paycheck. And this is where you can kind of really steamroll your investing. And this is when I started to realize, as became more of an accredited investor, that each of these properties that I bought was kind of cool. I would get roughly a few $100s of cash flow, but you go through a lot of work buying these turnkey rentals, and especially if you're going to do the burst strategy, you're going to need like 20 or 40 of these things to replace your income. And you start to realize that, wow, this is kind of trading sweat equity or time for money. And then, like I said, I started to join a lot of high-level mastermind groups with high-paid doctors, lawyers, engineers. And a lot of these guys, I mean, they were telling me this too, but their actions were speaking louder than with the words. And they were dumping their little single-family homes for passive investments in larger deals. And then I kind of stumbled upon this. It's a journey, right? Everybody, if you're a new investor coming into this world and you're like, well, what should I do, right? What's the best thing? And the way I teach my students today, it's not particularly like what's the best strategy. It's a strategy for where you are in your personal journey. And what the best way I've kind of distilled this down to is, people have, these free calls with me and I'm like, hey, cut to the chase, man. Where's your net worth and what do you make? And that's essentially where it is. When I was in my early 20s, I was in this simple passive cash flow 0.0 point, just make money, save money. And you could probably call people that are under $250,000 in this stage. But at that point, you should be buying, rental properties and building your asset column. Then when you become certainly a higher net worth investor, and especially a credit investor, this is when you start to transition away from the single family homes, which are kind of a pain in the butt, and you start to move to these passive investments. Here's a little flow chart because a lot of my folks are engineers. Being an engineer yourself, we like flow charts. But the way you kind of read this is when you start to invest, or when you start to have money to invest, you start to think about it this way. And it's more about a time thing. How much time do you have to investing? Well, most of kind of our investors, they are the type that don't have very much time. They have a busy multiple six-figure a year day job or business, and they have a family, and they are very crunched on time. So they're kind of going off into this right side. Whereas if you have a lot of time, likely you don't have very much money too. And therefore you may be better suited to be more of an active investor or a wholesaler flipper or a burst strategy there. But, if you've got some time, you're kind of in this middle run. But, most of the stuff we're going to be talking about today is geared towards people with little to no time and with some money. But certainly, everybody transitions to that point at some point, right? Like I said, all roads kind of lead to this kind of chubbier guy here on the right side with his golf club. So this is kind of me, like, I got to investing, I got some rentals, and then I started to, insert a multifamily syndication in there. And what's a syndication, real briefly? Well, a syndication is a group of people buying a larger asset. Now you can syndicate anything, right? You can syndicate a business, you can syndicate a light value add apartment complex where it's cash flowing day one and you're just doing a little bit of light upgrades. You can syndicate a very heavy multifamily upgrade or development, right? This is just a means for pulling investors' capitals together. And the analogy I like to use a lot of times is an airplane, right? In the airplane here on the right, you have the cockpit with your general partners or your lead sponsors, your syndicators, your leads. All these words kind of mean the same thing, even though. And these are the guys that find the deal, they source all the investors. The passive LP partners, they kind of come back and sit and coach, essentially, and as the pilots fly the plane. And again, the general partners, the pilots flying the plane, this can be broken up by one person, a handful of people, could be a dozen people. It's kind of rare. I always say, like, you want to have the least amount of cooks in the kitchen, just speaking from experience, because there's a whole bunch of opinions and, it's just better to have a succinct leadership. But those people in the cockpit, this is all the stuff they're doing. They're finding a property manager. They're working the relationships with the brokers, because that's really the biggest thing on these deals and what drives deals. They're the property inspector hiring that out. They're pulling together all the attorneys. They're doing all the paperwork. A lot of times they're the ones putting their own name on the debt as the key principals or loan guarantors, or KPs for short. They are the asset managers. They're playing investor relations to all the investors, keeping everybody updated on what's happening. And don't forget the last person is the people. And often these are kind of the most important people, the passive investors, the customers on the plane. So the nice thing about these types of deals is, from a first high level thing is, you're getting away from debt investments to equity investments. I think a lot of people starting out investing, they'll go to their local REIA, find a house flipper, and they'll lend their money. And essentially they are a debt investor is what that's called. So they receive a quote unquote guaranteed return on their money for a specific amount of time. This might range from like 8% to 12%, maybe a couple points or point or two of, for in there as a kicker. So this is sort of like a hard money loan in a way. But the bad thing and why I always stay away from this stuff is it's ordinary income. And we're not going to be getting into the tax side today of ordinary income versus passive income. But essentially the passive income I like because I can use my passive losses, the losses I get from these real estate investments through depreciation and possible bonus depreciation, which we'll talk about here in a little bit, to drive down my passive income. Whereas the ordinary income is getting killed. And the way I explain it to my folks, you're thinking about the ordinary income and passive income. They're both income. I guess you want both of them, but they're just two different colors of money. And you need after you become more sophisticated as a higher net worth investor, it's really not about the rate of return. It's more about taxes. And you become very keen to, is it ordinary income or is it passive income that you're talking about? These syndicated deals, a lot of times you're giving equity in a project. The downside is, you're not really getting paid a guaranteed rate of return, but you're being paid a split of the upside. And sometimes, and most times, the upside can be much, much greater than that little guarantee hard money loan in essence. And this is where you're getting higher returns. You may have to wait for it a little bit longer. But again, just insights into the higher net worth investor, they don't really care about making 5 to 10%. They'd rather parlay that and making 10, 20% plus through equity. And, before we kind of, go more into passive investing here, there might be some investors that still like to, roll up their sleeves, get their hands dirty, become a more active investor. I know a lot of the viewers here, you guys are IRA investors, where that's a huge no-no, right? You can't do that. I'm sure Brian tells you guys that all the time. You can't be a participant or you can't put sweat equity into your IRAs. But maybe you've got some stuff outside your IRA accounts or your qualified retirement money. And at some point, and I came up to this point myself as an investor. It's like, do you want to be the landlord? Do you want to manage tenants, contractors, DNS, deal hunting, broker networking? And the question is, do you enjoy doing it? As I tell most of my investors who are accredited investors already, make good 6-figure salaries plus, most of those guys, if you go into good deals with honest people, you implement a lot of the tax strategies and you add in a little bit of infinite banking in there too. You do that 1, 2, 3 combo. Most people can get to financial freedom in less than 5 years. 3 to 5 years is kind of the average. You need to start to begin with the end in mind, start to build your lifestyle. They call it 4-hour work week, the lifestyle design phase, and do things because you enjoy doing it, not just for the money. So if you like doing both of these, you're kind of a strange fellow, I think. Congratulations, you get to be a Class B and C investor, if that's the case. And you get to worry about all these sorts of problems that come up with being a landlord. Or you could be a sophisticated passive investor and just jump into a syndication and you focus on really your business, which is, after a certain point, managing your own personal expenses, enjoying your life, and just finding more deals from passive side and go away from your hard W-2 working job, as here I was. And it took me about 8 years to kind of get out of that working profession and get into the more passive investor where I just kick back and, hang out. I guess I don't really hang out too much these days. I'm still pretty active personally, but the idea is, passive investor, you start to move into your second phase in life where you're not trading time for money, but you're having your money work harder for you. And after a while, just this stuff starts to steamroll. And if you're caught on here, most accredited investors, especially in my group, they're all dumping their single family home rentals for these syndication deals where they're stronger deals, better tax benefits, and just quite frankly, just a lot less headaches. And this is the name of the game, right? And all this money didn't come from you working your day job, but it came from the passive investments. And this is this overall secret. Here's kind of a diagram of where people spend money in different categories like housing, food and beverage, transportation, and then the average total spend based on different economic groups. Your high income earners here, you're kind of your middle of the rung people here, and your low people here. I drew in this little call it the cheese slice color triangle here. This is all it is, and I call this the wedge. All the secret to financial freedom is expanding this wedge. The more money you make, the more money you're saved. But the key is to keep buying passive income generators and to expand that. And that's the secret to financial freedom. And for a lot of people, this is pretty breathtaking. I mean, if you've read the book, The Richest Man in Babylon, is pretty much it. Like, save X%. I think they said 10% of your income and just put it to passive investments. And over time, that wedge grows and grows and grows, and your money starts to work harder for you. And you start to move more to this passive investing side, which is getting away from these more active investing stuff to more of the passive investing ideas. And some of you guys may not be past that threshold. Your net worth may be less than $250,000, $500,000. Do what I did. Be very frugal with your money. Save your money. Buy more rental properties. But at some point, you need to start to think in terms of, all right, what's my competitive advantage here? Is it time, money, knowledge, and network? Well, if it's money and knowledge, then you need to stop using your time as much and become more of a passive investor. And this is a gumbled up slide here, but I went through all the ways you can make money in stocks, bonds, private notes, commercial syndications, rental properties, flipping. And if you guys want to take a screenshot of this and which ones are categorized as more passive income or active income, you guys can get this. If not, you guys can shoot us an email later on. And here's some of the pros and cons with those investments in particular. But here's how I kind of look at these things. This is a pretty popular diagram in my group where I put together a very rudimentary, non-scientific, of course, matrix of different types of investments that we'll use. And a lot of these you can use in your IRA, self-directed IRAs, or just invest cash. So on the left side, you got your more lower risk stuff, and the right side, you have your more higher risk type of investment activities. So, bonds are less risk than REITs, and 401ks and stocks. But I draw on this line, this dotted line here, you could do better. And basically the stuff below this line is what I categorize as retail investments, investments for the masses, or I'm sorry if this is offensive, but garbage investments, right? Like, we want to get into stuff that's above this line. Like, these are kind of the non-retail investments. This is the alternative investments that have been coined by, these institutions. Things like investing in private money or non-recourse syndications or buying rental properties or developing, flipping. I'm not advocating for one of these in particular, but if at the very least, just don't go to these bottom things below this line, because you're just not getting a good risk-adjusted return. And if this world to alternative investments is new to you, the analogy I like to explain this stuff is sushi. Brian's going to come down to Hawaii. I don't know if he eats sushi or not, but say he did it. I love sushi, so I obviously want to trick them into this type of stuff. Just like, your guys' friends who invest in alternative assets might have a portfolio of dozens and dozens of syndication deals, and maybe you haven't done anything. So back to the sushi analogy, what I'm going to do to Brian is I'm going to say, hey, you don't eat sushi. Well, let's try the California roll, which is just imitation crab. It's cooked. And he's like, all right, this is pretty good. And then we'll step him up to some shrimp tempura roll, and then we'll kind of hit him with the spicy tuna, which is raw, which I think he was maybe originally queasy with. And to link this back with real investments, like private money is typically a very common way that investors will get into investing in alternative investments, but that's on the debt side, that you don't have the upside. You're making your flipper very happy because you're giving him access to very cheap money, but he gives you none of the upside. The getting into the spicy tuna, that's kind of like getting a turnkey rental, right? But there's better stuff like that. And for you sushi aficionados out there, there is the salmon or the fish roll, the ikra here, which is kind of expensive. But this is maybe akin to getting into syndication deals, where you're going after apartment deals, or when the uni here is kind of like maybe going into syndicated development deals where the risk is maybe a little bit higher, but your returns are kind of going through the roof. Now, these days, personally, I kind of look at deals that are kind of all over the place, even outside of real estate. But this is eventually where the world you get into, where you invest in maybe non-real estate deals. I particularly invest in a lot of real estate stuff because I think real estate is very stable. At the end of the day, it provides a basic necessity. But yeah, what I kind of focus in on is investing in these kind of red states. I like to look at Class B assets today. We used to do a lot of Class C assets. They're just very difficult to work with, a lot of lower end tenants. And we just kind of found a nice little sweet spot in this mix between the high C's and the B's, and in better than B areas or better. And notice how we're differentiating between the locations and the asset class or the tenant class. But why do we do that? Well, the theory is in a recession, most people live in kind of C class or worse housing. That's if most of us, I think, listening to this call are kind of in probably banana republics. I feel like that here in Hawaii, or especially when I go to California. Most people in this country are not living like that. They make less than $60,000, $70,000 a year. They're paying $700, $800 a month for rent. And the idea here is, most people live in that type of stuff. And if there were ever a recession, this curve kind of shifts backwards. So this is why we like to stay in kind of here, this middle rung, to catch the A class as they move to the B's, as the B's move to the C's. The criteria that I like to look for today is cash flow and stabilized assets to get a hedge against that market correction, that kind of move back of that curve. And I focus in on debt service coverage ratio 1.25. Notice I don't call out the loan to value. Some people will say that, oh, you need to be looking at deals that have no more than 50% or 80% leverage. To me, that's a arbitrary number. You can have deals that are 50% leverage, but the damn thing doesn't cash flow. Like debt service coverage ratio is terrible. Debt service coverage ratio is what the pros do, what the banks do, is what we do. Loan to value is something that the amateurs look at that don't understand what debt service coverage ratio, or can't get a calculator out to calculate it. And it's just something that it's kind of quick and dirty way of kind of disqualifying bad deals. And we focus on forced appreciation. So on top of things that cash flow, we want to have an opportunity to bump the rents up and to make value add in a project. So how this kind of works its way out, like say you have a 100-unit building and you can just bump the rents up $45 by saving some expenses, or increasing the rents that are already on the market. 100 times 45 is $4,500, and times 12 is $5,400 increase to net operating income every year. And the magic formula for commercial assets is you go net operating income, in this case 54,000, divided by the prevailing cap rate, which is, we'll just use 5%. And you just bump the value of the building by $1 million. Similarly, if you save $40, maybe you build back some utilities to the tenants. You've created $600,000 of value right there. If you used I used an 8 cap there, so divided by 0.08 instead of 0.05. And another way of making money is reserve parking. And there's a laundry list of different things you can do. And this is very similar to, we call it a slow flip, right? We're cash flowing along the way, but every month we might be able to rehab just a mere 5 units out of a 100, 200, 300 unit apartment complex. And say we bump those rents up by just a mere $150. That's $4,500 a month times 12. That's $9,000 of extra net operating income every single month. That's being increased by the net operating income, about 100 grand a year. But I just wanted to break it down, how much value add you're increasing the building by every single month. And that's $180,000 every single month that's being bumped in value. And for me, when I saw this, I was like, yeah, what a great strategy. You can cash flow in bad times and cash flow in good times, but you're taking advantage of, forced appreciation, which doesn't take into account market appreciation. The market rents go up even higher. It's a beautiful thing. And this is kind of the basic upgrades that we'll kind of target. This is more of a class C to B upgrade. We can take it from a class B to a B plus, but this is just kind of great insight into kind of what value add forced appreciation is. And you got kind of the before and after. But this is what's going on. This is why I've kind of left these more turnkey rentals behind. And this is where the syndications come into play. It's just a force appreciating your assets more. Now I'm going to be going into some taxes stuff here. And I got the disclaimer here in red. I'm not a CPA, but I also don't have a JOB anymore. And that's unfortunately a lot of the CPAs have jobs and they haven't figured out how to do a lot of this stuff. They could do tax returns all right, but they can't put it all together. Most of the time, our clients come in and I would say 80% of the time plus, they have to change their CPA because their CPA just doesn't get this type of stuff. The CPA is more concerned with turning and burning and getting on to the next tax return, whether it's been optimized for the client. And most times the CPA just doesn't know. Again, CPAs know how to do tax returns. They may or may not know how or feel confident using these types of strategies. But here's what we do. Typically we look at a person's adjusted gross income. This is for single filers. This is for joint filers. $340,000 is kind of the point where we want to really show the client that they really want to be using some passive losses or some other alternative tax mitigation strategy to lower their taxes. And if you're making less than $340,000 as a married file jointly, I wouldn't worry too much. But certainly, the dentists, the doctors out there, definitely there can need to be really trying to focus on lowering your taxable income there to pay less taxes. Think about it. A doctor makes $650,000. If he lowers his income down to $400,000, he can save like $200,000 in taxes right there. That's a lot of turnkey rentals. So you guys came for 1031 exchanges. So as I was saying here, I was dumping my single family homes and going into syndication deals. The question that comes up a lot of times is, well, don't you need a 1031 exchange into a syndication deal, right? Because you're going to be selling the asset. You're going to be having the depreciation recapture and the capital gain, which I did, and which is encapsulated here from a screenshot from my taxes. So in 2017, as I was making the switch, I had sold, I believe, 6 of my rental properties. And I had a nice sizable capital gain and some depreciation recapture of almost $200,000. But I was investing in a variety of these syndication deals, doing cost segregations, getting bonus depreciation. And it was building up a huge glut of what we call passive activity losses in the years prior. And if I don't use them, it doesn't just go away. It stays suspended. And on my, I think 8285 form, you guys can Google that. But that's probably the most important form on your taxes for syndication investors and high net worth investors, how much passive activity losses you're carrying forward. But, you know, in this year, I think 2017, again, you know, I brought over $200,000 of it from here on 9/17 to wipe it out. And this essentially negated need to do a cost 1031 exchange. And this is the way you kind of transition out of this stuff. And this is also how you're kind of delaying taxes moving forward. We'll kind of catch up here. You know, I talked about bonus depreciation, cost segregation. I go into this more in detail, but I'm just going to go on a higher level. You know, the reason why we like real estate is we can depreciate the asset, not the land, but the asset. But with current bonus depreciation laws, you are able to greatly aggressively write off these properties. Yeah, so like, you know, your little single family home, you deduct 1/27th of the value every year over 27 years. It takes freaking forever to depreciate that asset. But with bonus depreciation and a cost segregation, which you can do on a larger property, it makes sense because a lot of these reports cost anywhere from like $8,000 to $10,000, where that doesn't make sense at all for like a little investor with their, you know, $1 or $2 million property. But when you're talking a 10, 20, $30 million property, it totally makes sense. And then that little $8,000 cost gets split amongst all the investors in a syndication. But yeah, the cost segregation basically juices the amount of aggressive depreciation in the front load, and why, you know, I think that's another case that, you know, tax benefits are better for syndication investors. And, you know, this is why I think 1031 exchanges are obsolete when you're investing this type of way. And I've kind of proven this, like, you know, this is like my tax returns. And a lot of this is on my website at simplepassivecashflow.com/tax. 2016 is when I kind of got into this stuff a little bit, paid 23% effective tax rate there. 2000. Oh, here's a little tip for some low income folks, or I don't want to say low income, but people that are making less than $150,000 a year. You can be using up to 25 grand of your passive losses to lower your income. So in this case, I think I had like 75 or 80 something thousand. So I was able to deduct 25 to get me down into the $69,000 range. I think this is my 2017. So I'm just kind of illustrating this. And, you know, again, I'm not playing CPA here, but these are the questions you need to be asking of your CPA. For those of you guys who make over $150,000 a year, you're phased out of this, unfortunately. So, but just for some of the lower income folks, I know that kind of sounds messed up, but you know, $100 grand, $150,000, calling low income. But anyway, 2018, this is when I really started to see the aha moment, right? Like I've gotten myself surrounded by other accredited investors, and you know, that year my AGI was 136,000, but I paid about $5-6 grand in taxes, effective tax rate of 4.2%. And then 2019 was when we really got it right. No taxes, because I drove the AGI way down to like 25 grand in that year. And all this is kind of been able to do by investing in syndication deals and aggressively writing off taxes. There's some of this that you're not seeing in the background, you know, real estate professional status, moving away from ordinary income, the passive income to be able to use the passive losses. But I'm just wanted to illustrate for folks that this is possible. And this is very common in accredited investor circles. But the idea, you know, I eventually went into like, I'm counting up all my K1s, you know, these next several weeks. I must have like 50 or 60 of these things, but these are kind of all the types of deals that I'm in my personal portfolio. As you can see, you're diversifying over many deals over different geographic areas, different types of deals, and you know, different spectrum between Class A, Class C, yield plays, heavy repositions. And this is all it is. I think, this is the secret to wealth building. It's not about investing in high risk, high return deals. It's more about re-leveraging that lazy equity. Most investors I talk to, and if you open up their portfolio, they've got a huge amount of their money making 0 to 5% lazy equity. Sophisticated investors always monitor the return on equity, and return on equity is the profit you're getting, which is the cash flow divided by the total deployable amount of income. And this is essentially what I'm talking about in graphical form, right? Like most people, they'll buy an asset, make a good return in the beginning, but as their equity position goes up, as the property appreciates, the return on equity, ROE, goes down. Most investors make the mistake of never 1031, refinance, sell the asset, put it into more assets and re-leveraging it. But this is what sophisticated investors do. And they re-leverage it into other deals. This is a very simple concept, but I would say most investors don't do this. And, this is pretty much it. I mean, this is a screenshot of like a very old picture I would draw for people. It's a very simple concept. You need to get your money working. Again, sell the asset, 1031 exchange, which again, I don't really think is practical as we talked about today. Cash out refinance and find that lazy equity and get it working. That's the secret to all this. Now we're kind of going into the IRA. Brian wanted to talk to me about IRAs for you folks here, because I know a lot of you guys have IRAs. But this is what we'll kind of do with some investors. We'll create like a little rough deployment plan. Not necessarily telling them where to put their money, but where's the money coming from first? And then that's where kind of your network, your deal flow kind of comes in, where you're going to invest these chunks of money. But the first things in order of operations that I like to do is, people are good savers. So this is depicting, this individual saves about $100,000 a year from their day job. They might have a little glut of cash lying around, maybe an inheritance, but those are the first things to go. We exhaust that first. Number 3A here, typically what I suggest is going after your lazy equity in your primary residence or your rental properties first. You can do that through number 1, HELOC, then refinance, and then selling it. Actually, I need to fix this slide here. And then the home equity here. But the 3B stuff is your IRA money, your qualified retirement plan money, and that's where you can start to invest that type of stuff. Because the reason why I put that below the home equity, because the home equity is doing jack. It's just going up with the pace of inflation, which is pretty horrible. And this is what frustrates me. All the financial dogmas is put money, buy a house to live in, pay it down. To me, that's one of the worst things. And that's why what's one of the first things I say to get the money out and deploy first. Your IRA money might be in retail investments like mutual funds, etc. And it's doing stuff. I think it's higher risk, but it's at least doing something. So that's why it's always kind of next on the order. And what most of my clients will do is they have a traditional set of investments such as mutual funds, bonds, stocks, but they want to self-directed. And then that's where, the self-directed IRA or solo 401k comes in. That becomes your vehicle to invest in this way and unlock that money to put it into these types of investments. But this is what you're trying to do. You're trying to flip the whole paradigm upside down. Right? The normal way of wealth building is build up your money, and at the end of your life, or you get to so-called retirement age of 60, 70, 80 years old, you want to have a big pile of cash and live off of it. But that's at that point, you're just dwindling your money down. What I say is, go in and start to build passive streams of income today. Build mini streams of maybe little rental properties or syndication deals, whatever it is. Just buy passive income generators one by one, and building this block from the bottom up. And also in terms of investments, don't go after the home runs. Just go after little single plays, little like stabilized light value add deals, and then use that to build your portfolio. And kind of do it that way. Whether maybe you start with some turnkey rentals and you build up some syndication deals after that, and then maybe you go into some more exotic investments after that. Some higher risk stuff like hotels or assisted living. I'd say start with the basic stuff first, the light value add or just simply rental properties, and kind of move up this value ladder slowly over time as your network grows and your experience grows. And this is the crossover point where you make more money, you save it, and then this red line is your decreasing motivation at work. You start to realize that this is all a rat race. And if your money can work harder for you at some point, there's some inflection point or crossover point where I have it drawn in around age 42 if you start in your 30s, but at some point you can quit your day job. And this is kind of where what started my whole simple passive cash flow passion project is a lot of people, they have problems with money and they start to go and have a lot of stresses in life. And a lot of this is an engineered system to keep a lot of you guys working, because it's not the wealthy paying the taxes, if we kind of saw. And it's not the poor people paying the taxes. It's folks like you, and it's also the people contributing to society. It's not the wealthy people, the trust fund kids. It's not the lower net worth people. It's the people like yourself who are the high paid working professionals that are powering the system forward. You guys are the doctors, you guys are the dentists, you guys are the engineers, you guys are the ones creating value in this world. And maybe it's by design, or just kind of my dark view on things. But to me, I mean, we kind of created the system to keep you guys all working. And I'm a fan of Tony Robbins, and something he said very where secret to life is kind of giving back to others. And simple passive cash flow to me is a way that I've kind of been able to teach other people to kind of do what I did, quit your day job, find your passion. And this concept of ikigai, I happen to be able to distill a lot of these noisy environment down to a very simple stream for high income earners, high net worth professionals. And that's simple. Invest in good deals where you don't get your money stolen. In typically real estate projects where you get good tax benefits, pay less taxes, and then do a little infinite banking, and you're done. It's very simple. And thus far, we've bought over $1 billion of assets within our community, $140 million from investors, over 50 projects. More importantly, I think we've got over 700 investors right now. It's a little outdated, but the 78% of investors choose to come back to us after the first year. And I'm thinking the 20% that didn't, maybe they just don't have enough money. They haven't invested yet. But yeah, this is kind of the, kind of something I've kind of spent a lot of dedicated my time since 2016. I started the podcast, which you guys can subscribe to, Simple Passive Cash Flow, Passive Real Estate Investing. But there's a world out there of wealthy investors, and they're doing things that are very simple. These concepts are very simple, but they're very counterintuitive to what we're all taught, by our parents, our friends and family, and definitely what's being talked about outside of the mainstream financial dogma out there. But with that, I'm going to go to the question and answer here. Hey, Alvin, good to see you again. Michael said, what software do you use to map that Sankey diagrams? Just Google Sankey diagrams, and I think one of the first search results comes up. Just use one of those. But yeah, it's kind of a cool tool. Greg says, this presentation was supposed to be about 1031 exchanges. So I did talk about 1031 exchanges in case you missed it there. The idea, the whole concept for me is 1031 exchanges don't really make sense. If you can use passive losses to offset your taxable gain, depreciation, recapture, it makes all that type of stuff obsolete. And I think that's what makes this financial world so hard, is everybody is kind of selling a tool, a solution. And not all tools or solution are used in certain situations. Like I think IRAs and self-directed IRAs are great for folks that are kind of trapped in those higher tax brackets and have a huge amount in the IRAs that are already today. I think that's a great use for that tool. 1031 exchanges, I just don't really see it. I just don't see it useful in most cases. there's just a lot of bad information out there. And yeah, another thing, I mean, as a passive investor, I mean, you always want unbiased information out there, right? The person selling you the 1031 exchange is, obviously giving you all the pros against it, but never the cons. To me, if 1031 exchanges make sense if you're needing to shelter a taxable gain of more than $1 million or several $1,000,000. If it's under that, you should be able to invest your proceeds and build up $250,000, $500,000 plus of passive loss to offset that gain. The problem I see is with 1031 exchanges is the metaphor I use is kind of like a hot air balloon, and that hot air balloon kind of goes up and up as your property appreciates. And if you're sitting in the hot air balloon and you jump out, if you have $100,000, $200,000, $300,000 capital gain, like how I did with selling those rental properties, I jump out of the hot air balloon, I break a leg, I'm not going to die, right? But the problem with going into a 1031 vehicle is, maybe I took those 7 rentals and I parlayed it again, and then come 5-10 years down the road, that $200,000 gain is now $500,000 or $1 million capital gain. And then at that point, I'm getting killed because my AGI blows up from $100,000 to $1 million, and I'm paying 50 cents on every dollar for that. So what I'm saying is, before your hot air balloon goes up too high where you can't jump out, get some passive losses to offset your jump out of the hot air balloon. And in this metaphor, this is like pillows, putting a whole bunch of pillows on the ground, so that when you do jump out, you can offset it partially, or like how I did it, I just offset it completely and then just landed to safety. But the problem is when you start to go into 1031 exchanges, you start to put all your money, the hot air balloon goes way, way higher and higher and higher, and you jump out and you're going to break a leg or die, right? Or this metaphor, huge capital gain tax at that point. But yeah, I mean, any follow-ups with that?
No, I agree with what you're saying, Lane. I mean, with the 1031 exchanges, you're just deferring the taxes for a property that's either worth the same or more. And most people would probably go with a value that's a property that's, bigger in value, and they want to keep getting bigger and bigger, but they don't think about the consequences down the road. And, who knows how long 1031 exchanges will even be around. And eventually you're only deferring the taxes for so long, and you're going to take that hit at some point, versus you could use a tax-free vehicle like a Roth IRA, or if you do it the right way, a solo 401k, and then you don't have to worry about, those taxes down the road at any point, because from the very beginning, you structured that deal the right way. So, I mean, everyone's strategy is different. Remember, we're not giving tax advice, but it's really up to you to figure out what's going to work best for your strategy. And where do you see yourselves in the next 10, 15, 20 years? Are you able to take that tax hit at that point?
Right. And yeah, we're not giving any tax advice, nor are we giving any investment advice either. But one thing I always tell a lot of my investors to be more conservative with their portfolios is you want to be diversified. Now, what does that mean? Well, I certainly think that means that you don't want to have more than 5 or certainly 10% of your net worth into any one deal. Mm-hmm. So when these guys are 1031 exchanging their assets, typically they've got a huge chunk of their net worth in that one deal. Like, they're going from a 4-plex to an 8-plex to a 50 unit, right? They've got a huge chunk of their net worth. And that's where I'm like, no, you shouldn't be doing that stuff, in my opinion, right? You want to be diversifying. You want to be diversifying more and more and more and more and more mm-hmm. Over time. And that's kind of why, that's the secondary reason why I'm not a huge fan of that 1031 exchange. At some point, you want to be breaking it all apart into smaller pieces so you can diversify geographically different deals, because you never know what's going to happen individually on each asset.
Yeah, so there's another question. Do all your investors need to be accredited investors?
I mean, a lot of the investments are typically more geared toward accredited investors, but there's some opportunities for some sophisticated investors. But yeah, I mean, I'd say most of the investors in these types of deals, I mean, 90% plus, 95% or plus are accredited investors. And that's why I kind of point to, that's why a lot of the lessons are in the story, right? Like, I think a lot of investors will look at these syndicated deals and these people, but they fail to realize, like, in my story, I mean, 2009 to 2015, I was just saving my ass off. It was just good old fashioned, just frugality and just putting away money to get your net worth to a certain level to then be able to parlay that into larger deals. And it depends where you are in the journey. If you're under $250,000, $500,000, I say just put your head down, keep saving your money, keep buying little assets, and then kind of get it going that way.
Yeah, I agree with you on that too. You want to diversify your portfolio to the best of your ability. Everyone starts somewhere. The sooner you start, the better. But you don't want to put all your eggs in one basket. And, whether it's real estate, private lending, in your IRA, outside of your IRA, what you're doing is you're just increasing the cash flow so that you're building your wealth in, all different aspects. That's what I like to tell my clients. And you can even partner on investments. If there's a minimum buy-in of $50,000 and you don't have it all in an IRA, you might be able to use some of your cash and your IRA and partner them on that investment. So I've seen clients do that as well, just so that they can take part in those deals and they don't want to miss that opportunity. Let's see.
Yeah, a typical investor that I'll see kind of, I think you see a lot, Brian, is, like a guy, we don't have too much cash on hand, right? What good investors do, you always want to have it working. So they might have 30, 40, 50 grand of liquidity or in the HELOC, being able to get that out. Mm-hmm. But, should you invest all of your investable funds into a deal? Probably not. But that's where, if you're able to unlock, most people were kind of duped into going into all those, those mutual funds, stocks, bonds, and they have a glut of that stuff in there, maybe $500,000, $1 million. Now, if you can kind of bring that on the battlefield, now it kind of makes more sense to invest the 50,000 either out of either or buckets. But if that just helps diversify your portfolio right there.
Yeah, I agree. See, another question: what software do you use to map Sankey diagrams?
Yeah, so if you just go to just Google Sankey diagrams and the online tool comes up.
There you go. Cool. Yeah, if you guys have any other questions that you're listening, you type them in the Q&A section and we'll go and read those. Lane, so are there any specific markets or any predictions for where the market's headed?
So our criteria for markets are red states, because we want the landlord laws on our side. But something that I'll do a lot is just I don't really so people ask, so what makes a good investable market? Well, number one, I stay away from these smaller markets. I would categorize a smaller market as under 100, even 250,000 population. Right? These are kind of your tertiary markets. Mm-hmm. I like to go at least higher amount than that, because so I can have a robust economic profile of employers, as opposed to just you got your one meat packing plant in the small town and the Walmart. Right? I'm not a huge fan of investing in those types of the markets, because you never know what can happen with that one or two employers. As far as what statistics out there to pull from, I mean, there's hundreds of statistics. To me, it might be a chicken and egg thing, but to me, what drives a good market is population growth. And ultimately, what population growth, the statistic it drives into, is rent increases per year. And this is a statistic that you can find a lot of places. And what I like about it, and why I think it's such a clean stat, is because it takes into account supply and demand. Mm-hmm. Because that's what the price people are paying, right? Yeah. As opposed to arguing where there's a lot of supply or new inventory coming online, or a lot of demand in terms of population growth for product. Let's just see what the prices are, right? So I would, you can Google rent increases per year, and either, the apartment world is a lot better data on this, and that's why I like to invest in commercial assets. But you can also find it for single family homes, even though it's a little bit more sporadic. But to me, that's really the quick and dirty way of vetting a location. Rent increases per year. Yeah. Typically, 2-3% is typical. That kind of just goes up with the pace of inflation. But starting 2021, man, things were just skyrocketing. Mm-hmm. But it should level off again. But all we want is that little growth over time.
Yeah, I know in Florida, we had people coming in groves from the north all relocating down to Florida. I mean, people from California were coming down to Florida, and the market's pretty crazy right now, and they're opening more and more developments for 55 plus communities, as well as multifamily apartments. And not only that, I'm seeing a lot more of these older apartment complexes with brand new paint, brand new names, and that it's the syndicators are out there and they're raising capital and they're scooping up these properties pretty quickly, and they're flooding to Florida. And there's a couple other markets like Austin I've seen. So when you guys are doing your due diligence out there, you want to look for things like Lane mentioned, what does a population growth look like? And that might be what, makes or breaks your investment. That's something definitely to take in consideration as you're doing your due diligence. So yes, there will be a replay. We post all of our videos on our website at NuViewTrust.com in the blog section, the educational resources section. Follow us on YouTube. If you follow us on YouTube, you'll always get a reminder that we have a new video out there, and we do them every Wednesday at 1 p.m. A lot of great content there for you. So one last question. Okay, I'm confused about the approach of building up passive losses to offset the AGI. Can you clarify why that approach is preferable to not having passive losses and going ahead and paying the taxes due?
All right, so this is kind of complicated. And again, I'm not giving any tax advice here, but this is why, syndication investors kind of have a leg up, but we have options. There's not one way of playing this. And I think this is what puts CPAs in a hard position, because they don't know what you're going to be doing in the future in terms of what passive losses you're going to be getting in the future. And they certainly don't know which deals are going to be exiting in the future. So you may need some passive losses or dry powder in this case to offset that in the future. So the way, kind of just backing up, just so we don't leave anybody behind, there are kind of two different types of income. There's ordinary income and passive income. There's some other ones, but like royalties, but let's not get confusing here. The main ones that most people have are ordinary income, which you get from your job, your 1099, your capital gains on flips, right? Which is why I don't like flips, because it's ordinary income, or your private money lending is typically ordinary income. Bad color of money. We want to be getting away from that eventually. The good color of money is passive income, right? Which you get from rents and deals that are kind of longer term, certainly more than a year long. The reason being is because we're getting passive losses through the depreciation of the asset, and we can use that, and that can be stored up in terms of passive activity losses, or PALs for short. We can use these PALs to offset the passive income that we get. And oftentimes that drives that down. Now, I think the question is, they're asking, confused by the approach of building up passive losses to offset adjusted gross income. So your adjusted gross income essentially is kind of a composite of like the net of passive income minus passive losses, and then your ordinary income side. So I'm going to separate the two here. So like what they're asking is to offset AGI. You can't use the passive losses to offset ordinary income, therefore your AGI, right? I'm just kind of separating this out, and it still might be a little bit confusing, but kind of follow me here. You can't use passive losses to offset ordinary income unless you're able to implement a real estate professional status strategy, REPS for short. And we're not going to be going into this, that kind of requires a couple hoops to jump through that are not super hard to satisfy. But if you are able to do that, now you're able to use the passive losses to offset your AGI or ordinary income in this case. And then that is a powerful approach that some investors will do. So some of my investors are doctors, and they make $1 million a year, and conveniently their spouse doesn't work, and so they're going to be the real estate professional. We're not going to be going into how they qualify for that because it gets a little complicated. But what they're doing is, they're investing very heavily into syndication deals. These guys, they make a lot of money. So going into $250,000 here, $250,000 here, they may, let's just say they accumulate $500,000 of passive losses every single year, and they have, $500,000 of passive losses built up or suspended passive losses. So at the end of this year, say they have $750,000 of passive losses. Now they have options here. They can sit back and just have a suspended passive losses carry forward to the next year. They're certainly probably going to use the passive losses to offset all the passive income, but they have a choice here. Do they want to drive their ordinary income, or in this case, eventually the adjusted gross income down? Does this make sense for them? Now, if you go back to the slide of like the tax brackets, right? And this is where, does it make sense to drive them down to that 340 mark or $400,000 AGI because they're in those higher tax brackets? But does it make sense for them to drive them all the way down to zero, right? Because some people will think that it doesn't make sense to do that because at those lower tax brackets under 400 grand, under $340,000, you're not getting super killed with taxes. We're in a progressive tax system, so those lower rungs, you don't pay very much taxes. So it's a judgment call, and it has to be led by the investor. This is why we always say, as investors, we need to be educated and empowered to have these conversations with your CPA. Typically, the CPA is going to be like, oh shoot, like there's no one way of playing it. Like I said, they don't know what you're investing in. They don't know how much passive losses you're going to be getting in the future. Therefore, a smart one is going to he's going to be like bow out gracefully and say, it's all you, man. The people, now the problem is most investors don't have a clue how to do this stuff. And so does a CPA. They don't really have the insights of how to play, strategize this stuff. So they just file it and like next on, right? But this is where you as an investor need to get educated on this type of stuff so you can lead these interactions. And first off, determine if your CPA is even willing to play ball and understands this stuff. And if not, find a new one. But this is where, like, to me, and again, not giving any financial or tax advice here, to me, it makes sense for that high income earner to drive their AGI down to the $300,000, $400,000 ranges, right? To use up some of the passive losses, especially if they have that much, $500,000, $1 million to drive them there. Some of my investors, they're like, screw it. We're not going to pay any taxes. We're going to use up all our dry powder or as much of it to drive us down to zero. We don't want to pay any taxes. But the problem with that is they may not have dry powder in the future. So when one of these deals cash out, they're like, oh shoot, now they're like a drug addict, right? They're like, I need some passive losses, right? Like, what deals are there? I just need to get some passive losses. And that's the downside of playing it that aggressively. So as you can see, there's no one right way of playing with this because the tax laws could change slightly in the future. They may say, oh, you can only use 30% of the available you can only lower your AGI by 30% or 50%, right? Not the case now, but you never know what's going to happen in the future. This is why I always say you need to get around other high net worth accredited investors doing this type of stuff. You invest through an IRA, you don't really have to worry about these types of things because it's insulated in there. But you got your IRA portion, you got your cash portion, and nice thing about the cash portions, you can use these as levers to lower your AGI as accordingly. But I mean, any follow-up questions to that? I know that's kind of confusing, and it was confusing to me. I mean, it took me a couple of years to kind of really get this in my head. At first, you're kind of like, it seems illegal. It doesn't make any sense. But after you hear it maybe 3 or 4 times from a couple different people, then it starts to make a lot of sense, I think.
Yeah, I know I've heard of this strategy as well, and I've seen clients use this strategy. Clients are investors that use their cash. Obviously, you can't offset it with your self-directed IRA money because it's already tax deferred or tax free. Just depends the type of IRA you're using. But no, I've definitely seen that approach. So we're going to go ahead and wrap it up like that. Lane, if anybody wants to reach out to you one-on-one, how can they reach you?
They can shoot the team an email at lane@simplepassivecashflow.com. And we're not giving tax or legal advice here, but we work with I think well over like 8,000, 10,000 investors in our group now. We see this stuff from time to time. My whole idea is get you thinking about this stuff, but then you bring in your professionals, your accountants, your lawyers. You guys kind of do this the right way. But yeah, if you're don't listen to anything I'm saying. I'm just an engineer that quit my day job, kind of did this stuff myself. But do your own due diligence, folks.
Yeah, so definitely check him out. If you want to reach out to him, Lane at simplepassivecashflow.com. Check out his podcast, a lot of good videos that are watched as well. Anyone listening, if you're not already a client of NuView, we're running a promotion for the month of April. It is spring 22. That is only if you open 2 accounts or more, and we will waive your application fee as well as add a $50 credit towards your account, so your first transaction. And then a few other things. If you have questions, you want to set up a consultation, just reach out to us at iraspecialist@NuViewTrust.com. That's the best way to reach me or someone on my team. Lane, once again, thanks again for joining us. Can't wait to see you in Hawaii next week. I'll be there. We'll have to do coffee. And last thing, our social media, if you scan the QR code, you'll be able to get the recordings, like I said, on our YouTube channel.